this is a question we get a lot, and it's switching to like the warehousing side of our business. So how does that work? Who pays for that insurance? Now, obviously, you know, there's a couple scenarios, maybe cargo that we deconsolidate as a CFS station and then ship out. It maybe sits on my dock for a day or two. And then that cargo that moves into our facility for long-term storage. Where does that insurance product shift it? And is Scarborough the one that's responsible to insure that cargo once it's sitting on our dock as far as if something were to get damaged? Or is that the individual company's responsibility to make sure they have insurance that covers their product even though it's sitting at someone else's warehouse?
Sure. You know, and that's where we want to have folks looking to you guys to use your broad policy for that door-to-door insurance. It does cover when goods are in transit and in a warehouse for a couple of days before it goes to the port or before it gets delivered to the final destination. But to answer your question specifically, the shipper's interest insurance is what is the best product that would protect the goods while they're in the warehouse. So if you are providing that to your clients and they're receiving that door-to-door coverage, then they would have coverage there. Now, if they needed coverage that was going to be sitting in a warehouse for actual storage, and it's not consolidation, deconsolidation, that's something they could also look to you guys to provide for them as well.
But it is a separate policy, and I think that's the point that I wanted to make sure that your normal cargo insurance doesn't cover your product if now I take control of it as maybe a fulfillment center, and I take in a pallet or I take in a container's worth of goods that might sit here for 60 or 90 days, and we might ship out a box or 3 boxes at a time.
That's correct. However, with that being said, you know, if Scarborough is going to be handling a high volume of that cargo and it's going to be in that warehouse for an extended period of time, you know, that's certainly something that you guys and Roanoke could work together on to maybe give them a one-stop shop coverage. But the short answer to your question is yes, that warehouse storage would be considered something different than the door-to-door transit.
Okay, perfect.
Yeah, and Adam, just to put a little finer point on it really quickly, you had asked a specific question as to who had the responsibility to insure the cargo. I would just add that the service provider, whether it's a warehouseman or a trucker or an ocean carrier or an air carrier, the service provider never has a responsibility to insure the cargo unless there's been an agreement to do so. If the cargo owner has asked the service provider to do so and the service provider has agreed to do so, then okay, the service provider has the responsibility to do it at an additional cost usually. However, absent that agreement, the service provider never has a responsibility to insure the cargo. The service provider may choose to insure their legal liability for physical loss or damage to that cargo. As we were talking about the carriage of goods by sea act costs, where it's $500 per customer shipping unit or something like that. But that's always going to be a defense-oriented coverage, and it's always going to seek to defend the service provider from any sort of liability, first and foremost. So again, please, if you're an importer, an exporter, a shipper, please don't rely on your service provider's legal liability insurance to make you whole in the event of a loss. If loss or damage in transit is something that you're concerned about, you need to consider shipper's interest cargo insurance.